Learning Objective 14-3 is probably one of the most important sections of this entire class. And you've got to know what we're about to go through. And every accountant should know this information. Of course, it's going to be on the CPA exam. But more fundamentally, it's just key to understanding certain things about how accounting works. And this is something that you should know and commit to memory. Periodic reporting requirements of the Securities and Exchange Commission. Companies with more than 10 million in assets and whose securities are held by more than 500 persons, and this is most companies, must file annual periodic reports to update their economic activities. And there are 3 forms to know: the 10K, the 10Q, and the 8K. There are other forms. The 10K is the annual filing, and what are called large accelerated filers must file within 60 days of the end of the fiscal year. So who are large accelerated filers? They have market value exceeding $700 million. Accelerated filers are 75 million to 700 million, and that changes sometimes, and they have 75 days. And then you have small businesses who don't meet any of these requirements, have 90 days. And this is really important to know. The fact that the 10K is the annual report and who needs to file when. Now, the 10K has 4 sections. Part 1 is just a description of the business, but it can get pretty long. Part 2 is the part that interests us the most. This is management's discussion and analysis. It's management's explanation for what happened during the year. Audited financial statements and footnotes. I hope you know what that is. Report by management on internal control structure, assessment on the effectiveness of those controls, and the auditor's opinion. The auditor's opinion also will include a statement on internal controls, and 5 years of condensed financial information and disclosures. This is the additional financial information that provides a longer period. And oftentimes companies will provide 10 or 20 years of information. And the nice thing about this last bullet point here is that if you're going to do financial analysis, this usually gives you everything you need to know in order to do financial analysis. Part 3 has information about who the officers and directors are, executive compensation, and the auditor fees. And Part 4 has additional schedules and exhibits. So this is the Form 10K. The second form, Form 10Q, is a quarterly report, which we talked about quarterly reports in the last chapter. And it has a much tighter deadline. Large accelerated filers are 40 days. That'll be after the first 3 quarters, because after the 4th quarter, that's the annual report, right? The whole year is over after the 4th quarter. Other companies that aren't large accelerated filers need to file within 45 days. And 10Q has 2 parts. Comparative financial statements, as I showed you in the previous chapter, and also an update on significant matters. Really, the quarterly report is not designed to give you all the information. 10K is designed as a comprehensive statement that has everything you want to know. And the financial statements need to be audited. The 10Q has much less detailed information, but it provides you with a helpful update so you can find out what happened since the last 10K. The Form 8K is for anything that's kind of a surprise, what's called a triggering event. Examples of triggering event would be a chief executive officer resigns, there's a major lawsuit against the company, a regulatory action is taken against the company. There was a recent incident, a plane crash with a 737 MAX, and then several countries, including the United States, have grounded the plane. So Boeing, which makes the 737 MAX, this would be considered to be a triggering event, and Boeing would be required to file Form 8K. Schedule D is pretty cool. If someone acquires a beneficial interest, 5% of the company's stock, the company needs to file a Form 13D. So it's interesting, if you have 4.99%, you don't need to file it, but once you break that 5% threshold, you need to file it. The purpose here is to know who's buying the stock and to signal people that there may be a takeover occurring. What's called a beneficial ownership is where someone has the ability to vote shares. So it's not only where you own the stock, but you may own a corporation that owns the stock, or you may have a close relative who owns the stock, whose shares you can vote. So the interest here is to signal, again, investors that someone is buying the company's stock and that there may be a takeover going on. There's also something called proxy statements. Stockholders, if anyone here owns stock, then you know that you get proxy statements in the mail. And in fact, they still come in the mail. It's pretty cool. Stockholders vote. You can vote on the members of the board of directors and certain key issues that are of concern to the company. So the proxy statement is designed to give you the information that you need before you make that vote. And what's very interesting in proxy statements is it has compensation of the key executive officers. Now, accountants' legal liability is a very strange issue because the 1934 Securities Exchange Act actually protects accountants and limited their legal exposure, basically saying that if accountants follow the rules of due diligence, what accountants are expected to do, they can't be held legally liable for anything else. The only time you would be able to hold an accountant legally liable, and this includes this includes accountants working for the company, I believe, would be if they don't take the due steps that they're required to take. And they also impose civil liability that accountants could be sued for filing materially false and misleading statements. And in the old days, it had to again be a situation where accountants clearly did not follow the rules that they were required to follow. So they have an obligation of what's called due diligence. And an accountant, as long as the accountant can appropriately use due diligence, in other words, they did their job. I did what I'm supposed to do. This is what auditors are expected to do when they audit financial statements, and that's exactly what I did, and here's the working papers. And as long as they can show they did their job and they did everything at a professional level, then that would be an adequate defense. Now that's been weakened with Sarbanes-Oxley, Enron, and some of the recent scandals, and accountants don't necessarily have this defense anymore. What's also come in is criminal liability in certain cases, which was rarely the case before Enron. And it's very useful to know what EDGAR is, if you haven't already seen EDGAR. Electronic Data Gathering, Analysis, and Retrieval. I never knew what it stood for. Everyone calls it EDGAR. And this is an online database that has all of the SEC filings in it. And one of the great things about EDGAR now is that EDGAR has they've developed ways to extract data and do more sophisticated analysis. It used to be that everything was just a text file, and now they have PDF files, and now they have even more accessible files with a system called XBRL.